Oh my gosh, absolute disaster on PPI. We're going to go through this, but we're also going to talk about what the Federal Reserve thinks about January. Big deal. So if you're wondering why the market is acting the way it is for PPI, this video might give you some insights, just like the insights you can get in the programs on Building Your Wealth link down below. 69% off flash sale expires Friday at 11:59 p.m. on all of the programs on Building Your Wealth and the shadowing experience. Keep in mind on the shadowing experience, we're not guaranteed to travel. You might be shadowing me in the office, in the car, or if we're traveling somewhere, maybe that's included. We'll see. But anyway, let's get into PPI. Now, we must talk PPI. You ready for this? PPI numbers coming in right now. PPI coming in hot, hot, hot. That's not good. PPI final demand coming in at 0.7. Oh, that's not good. That's bad. That's bad. You've got PPI expected was 0.4. You got 0.7. That is no bueno. Then you got core X food and energy. You got 0.5 versus the 0.3 expected. Also not good. Oh, this is terrible. PPI X food, energy, and trade. Oh, dear Lord. 0.6 versus 0.2 expected. This is a terrible report. This is not good at all. Holy smokes, PPI final demand 6% year over year as opposed to the 5.4 survey. PPI year over year, less food and energy, you're looking at 5.4 versus 4.9. That's also beat. Or in other words, a worse number, a higher number. PPI X food, energy, and trade year over year coming in at 4.5 versus 4%. Terrible numbers. Absolutely terrible numbers on the PPI. That's not good. You do have housing starts that just came out as well. Minus 4.5% on housing starts. You were looking at 1.9. The last was also revised up substantially. Negative 1.4 was revised to negative 3.4. That shows you more slowing, substantially more slowing in the housing market than markets have expected. However, this PPI number is absolutely terrible. Markets basically moving straight down on this news. You went from about flat on the NASDAQ, a close of yesterday of about 309. You're sitting in pre-market right now at about 306. You got most stocks turning red here in the pre-market, from up about 0.5% on Tesla, down now about 1%. It's going to be really interesting to see how markets try to explain this one away. But holy smokes, these PPI numbers were terrible. These are not good PPI numbers. Let's try to see what's actually going on. PPI report, so we can get to the bottom of what's actually in the report. But I'll tell you this, from what I'm seeing here, just these headline numbers, every single beat, not great. Not great at all. We're going to go print up the PPI report right now so we can look at it together. Again, this is a beat across the board on everything, and I'm not talking about a little bit either. This is a terrible survey. Now, there is murmuring, and I want to start by saying this. There is a lot of talk circulating that maybe, and I'm not trying to just pull this out of the hat, conveniently because it was a bad report and, maybe Kevin leans a little bullish. Okay. But anyway, there is this talk about how surveys are potentially starting to become less reliable. And I read this yesterday, so it has nothing to do with what the survey was today. I was going to talk about it anyway. But look at this. The survey response rates are plummeting. Survey response rates plummeting on population surveys, employment statistics surveys. The response rates are going from 60% to approaching 40%. Look at the JOLTS report. I mean, a plummet from about 70% response rate to like a 38% response rate. An absolute plummet here. Employment cost index report plummeting. So you're getting these massive plummeting response rates. And it's not me, but it's individuals are expecting that these response rates are potentially going to affect and skew the data. Because really what you're getting is the Census Bureaus or the Bureau of Labor Statistics, they're sort of trying to apply different weights to responses to try to fix these weird lack of responses we're starting to get. And some folks say that businesses that are having sort of worse reports are less likely to actually respond to this information because out of maybe it's embarrassment or they don't want to talk about how their business is doing poorly. They're kind of tired about that. I don't know. But this PPI report, either way you slice it, is not good. This is starting to look very sticky. And sticky is nice when it's transitory, but, otherwise, or you're playing with Play-Doh or something like that. But, you don't want to be sticky all day long. And right now, this is starting to look a little sticky here. 0.7% in January. And think about it. Every report for January has been hot, right? We had CPI hot. We had jobs hot. and now we have PPI hot. Like January is just a hot month. Now, some say it's possible that January is so hot because you actually have this potential warmer winter than you usually do, and because you have a warmer winter, maybe people are spending money on spring clothing more and earlier than expected at higher prices, and this is why you had an apparel jump. You had a little bit of a pop in oil prices because of the potential that China's reopening was going to drive oil prices up, so you had some initial speculating pushing up oil prices. Anyway, so we already read the numbers out. Let's actually see what this was attributable to. So final demand good moved up 1.2% in January, largest increase since rising 2.1% in June of 2022. The January advance is attributable to a 5% jump in final demand for energy. Now remember, energy is, even when you strip it out for core, it still ends up increasing the cost of other goods within PPI. That's because, even though you could have like a real estate agent as a core service, as an example, their costs might actually be going up because it's more expensive to drive around. So maybe, for example, real estate agent might not be the best example, but let's say a bookkeeper or whatever wants to charge more money, whatever, right? Expenses go up when oil and energy prices flow through the economy, so people have to end up raising their prices. This is not good, though. I mean, these are pretty big numbers here, and so far this is a miss on everything here. We know that energy moved up. What else here? The index for residential natural gas, diesel fuel, jet fuel, soft drinks, and motor vehicles also moved higher. We actually did see that. Both Pepsi and Coke talked about higher prices. Prices for fresh and dry vegetables decreased 33%. Okay, well, nobody wants those anyway. Then you've got organic chemicals declined. Oh, really? Lower organic chemical expenses, while at the same time they're all spilling in Ohio. That's interesting. So index for final demand services, 0.4% in January. What would cause this here? Let's see here. Less trade, transportation, warehousing. So over 80% of the broad-based increase in January is attributable to prices for final demand services, less trade, transportation, warehousing. Wow. That shows you sticky services right here. We saw this in the CPI report as well, which is not good, but this is sticky services right here. Sticky services right here, when 80% of the PPI move for services is basically broad-based outside of just trade, transportation, warehousing. 80% of the increase is based on those services outside of trade, transportation, warehousing, which is basically everything else in the services sector. Product detail, let's see here. Hospital outpatient care jumped 1.4%. Automobiles jumped. We saw this with the used vehicle reports. Health, beauty, optical retailing, portfolio management, airfare, passenger services moved higher. Margins. Okay, let's see here. Let's look at the actual chart here. Let's see. Intermediate demand. That's fine. Okay. I want to get a little bit more detailed on some of the actual items. So let me get the detailed chart here. But so far, this beat is not going to make for a great day for the market here. Stocks per Wall Street here, extending losses, dollar turning positive, yields ticking higher. The yield part ticking higher is very interesting when it comes to real estate because as much as people got excited that rates were starting to come down and people were starting to get pre-approved at lower rates again, you actually have rates moving up again. So you're going to get potentially just this very temporary pop, and then you'll end up getting potentially a decline again in real estate. So not so great. A little head fake here for real estate as rates continue to move up. And you saw with housing starts as well, complete disaster on housing starts. Now we're going to go look at some of the actual categories here that we have for PPI. Let's see here. Getting PPI here. Okay, looks like final demand foods, December to January. Final demand foods actually in aggregate down 1%, but final demand goods in general up 1.2% on the seasonally adjusted basis for final demand goods. That's actually not ideal that you're starting to see a little bit of a pickup again in goods inflation, right? That's what we don't want. We don't want to see any kind of pickup in goods inflation. And you're starting to see that increase on PPI. Now, that doesn't necessarily have to come over to CPI if companies end up taking it in the margins, right? They take it in the margin. That's possible. It's very possible. But it's still showing you these sort of more broad-based price pressures, right? That's not good. And what's also not good is now you've got people in the comments saying things like Team Bury and putting up little bears here. So what do we got here? Final demand goods up 1.2%. That's not fantastic. Final demand foods here, minus 1%. Fine. Let's go ahead and get past that, maybe with the exception of coffee, up 1.9%. Wow, it's not good for Starbucks. Alcoholic beverages, let's go, minus 0.1%. Thank goodness. Okay, no price increases there. That's fantastic. Although in the UK, I was reading some reports yesterday that you had restaurants and travel go down, but alcohol prices were going up because demand for alcohol spending was up. So I don't know, maybe the people are sad in the UK, but anyway, maybe they're sad they didn't get Liz Truss. So what else do we have here? Industrial machine handling equipment up 0.7%. Electronic computers and computer equipment up 2%. These are like massive moves here. It just makes you wonder, like at some point, do we still trust all of these surveys that are just coming in all over the place? Like, why is it, the last 3 months of 2022, everything seems like it's disinflating and yay, disinflation is here. Now all of a sudden it's like a rug pull again. Nope, inflation's back. This is wild. What is this? Tires up 2.4% for tires in a month? Good Lord. Construction machinery and equipment up 3.4%. Holy smokes. This is so broad-based. I don't know how you could say there's disinflation in producer prices when it's this broad-based. And I'll tell you, I even said it in CPI. I'm like, man, it's still pretty broad-based where you're seeing the inflation on services. Now, it was nice the market was rallying, but it's like, I remember saying to course members that day, I'm like, I don't know, the CPI report doesn't seem that great. The market rallied anyway. And I'm like, okay. Don't get me wrong. I appreciate the rally, but these January reports suck for the disinflation narrative. They suck. All right, what else do we have here? We got 3.7% up on lawn and garden equipment. Okay. Truck trailers down 1.3%. Okay, so a little bit down. Cigarettes are going up. Oh no, 1.7%. Mobile homes, though, folks. Mobile homes are 1.3% less expensive. I think that's fascinating. Don't buy a mobile home ever. It's stupid. Costume, jewelry, and novelties. Okay, 4.6%. Then you've got apparel wholesaling down 6.7%. Look at the volatility in some of these numbers. This is just insane how volatile some of these numbers are. This is remarkable. Sporting goods, including boats and retailing, up 10.1%. It just makes you wonder if the seasonally warmer winter pushed this up, right? Health, beauty, optical goods retailing, 4.1%. But then over here, fuels and lubricants down 17.5%. I don't even know what to make of this data. It seems hot, but it's just like all over the place. It's kind of exhausting how all over the place some of these numbers are. How are we doing on lumber? What is this? Look at this. What is it? How are you supposed to understand this at all? Look at this. Hardwood lumber down hardwood lumber up 9.2%. Oh, but wait for it. Softwood lumber down 9.7%. So one's up 9%, one's down 7%. Like, what is this? This is so confusing. How some things are just massively plummeting. Some things are massively increasing. The survey responses are plummeting. The weights are changing. It's a warmer January than usual. People are keeping more employees than usual. I don't think anybody knows what's up or what's down anymore. This is wild. Speaking of what's up or what's down, you've got the NASDAQ sitting down about 1% right now. Honestly, for how terrible this report was, that's not even that bad. It could be even worse. Now, we'll see what the day does. But this is supposed to be a horrible report, right? The bond market's barely responding. 3.8%, the 10-year Treasury's flat. It's flat, 3.81%. This is just wild to me. I would say, if I had to try to conclude this, I would say, first of all, it's bad news. I'm not trying to put bullish news or water this down. January, these are terrible reports. Now, the Federal Reserve did tell us yesterday, January is the biggest month of the year for seasonal adjustments. So you have to take January with a grain of salt. The Federal Reserve said that. Okay, keep that in mind. The Fed said that. That could be why the bond market is relatively flat right now. You would expect after that report, 10-year Treasury yields to skyrocket. Maybe the 2 years are moving. Let's go pull the 2-year. Your shorter term Treasury yields. Not really. 0.01. Yeah. I mean, this is basically flat on the 2-year even. So you don't actually really have a bond market that's saying, oh my gosh, we're freaking out over this. Now we'll see. Maybe it'll change throughout the day. You do obviously have the NASDAQ rotating down about 1%. And we'll see if it gets worse as sort of the day goes on. You got the SPY down 0.8%. What's the dollar doing? Let's go to U up over here. We'll look at the dollar index, potentially, nominally up. I mean, do we have the DXY on Webull? Let's just look at the dollar. I mean, the dollar should be rising, but at least per Webull here in pre-market, you're not seeing much of a movement. But you would expect the dollar would be rising, but then again, yields aren't really rising. So maybe the market's kind of like, whatever, it's January. If we rally today, which we've seen this many times, over the last multiple weeks, we've seen many times, red pre-market, green close of business. If we rally today, what you're seeing is people taking money off the sidelines, throwing it in to the markets because they see this as potentially a short-term buy the dip opportunity, and they're actually just writing off January as, well, January is just seasonal adjustment month. And this is a weird season. It's also, I mean, it's very unique given that you're coming off of the pandemic. That's the only way you could be bullish about this because the actual reports are bad. So the fact of the matter is, it's bad. In fact, you're going to get more and more stories about this, but here, look at this. The PPI data was decidedly unfriendly to the disinflationary narrative. Not only did it come in quite a bit higher than expected across all aggregates last month, true. I mean, this was terrible. These were terrible results. But prior data was also revised up. This left year-over-year readings higher than expected by 0.5% or more across all aggregates. All aggregates up over 0.5%. Ouchie wouchies. Meanwhile, jobless claims remained well behaved, with a smidge lower than expected and continuing claims pretty much right on forecast. On the other hand, the Philadelphia Fed continued its zigzag relationship with the Empire Survey, printing well below expectations for manufacturing. Interesting. And then, of course, housing starts got destroyed. But the big deal is PPI, which is probably going to move up terminal rate expectations. But then again, I'm still not seeing movement in the bond market. Maybe we'll get it throughout the day. That's what I would be paying attention to. So if you want to know, is the market discarding this madness? Then I think it's very important to think, okay, let's go ahead and see what the bond market does today. Now, Loretta Mester is apparently just came out and started talking about how she saw a compelling case for a 50 basis point hike at the last FOMC meeting because she says that there's still a lot more work to be done on inflation. That's not great. But with this PPI report, you're probably going to get some Wall Street analysts starting to call for a 50 basis point hike again for the March meeting. We'll see how expectations end up pricing out right now. Right now, nobody's really expecting a 50 basis point hike. That would be a little bit of a rug pull. You do have markets selling off a little bit more, though, after Loretta Mester's suggestion that, hey, we see a compelling reason for potentially a 50 basis point hike, or at least she saw that in February. We'll see if that sort of pressure ends up getting more support in March. I don't think it will. I think it's much more likely that they would just attach another 25 BP hike in the summer. So instead of potentially pausing in May, you get a pause in June or July, right? And you sort of push back another 25. That's been relatively consistent with what Jay Powell has been looking at. But Loretta Mester's comments coming conveniently right after the PPI report suggesting, I was actually pushing for 50 in Feb, probably is going to lead the market to take a little bit of a breather on the rally that we've seen. Again, if we end up pushing up throughout the day, it's, in my opinion, a sign that markets are taking cash off the sidelines. They're buying the dip. They don't believe the January reports. If the market continues to trend down, maybe finally after a strong jobs report, strong CPI report, and now a strong PPI report, and I mean really strong PPI report, maybe it's time for the market to start waking up a little bit and realizing, okay, maybe we shouldn't be rallying straight to the moon. Although there's nothing like 2-week call options to take you to the moon or to zero. Anyway, That's PPI for you. Boy, that was a disaster. But the good news is you can still get 69% off with a flash sale for the programs on Building Your Wealth. Link down below through Friday at 11:59 p.m. Steve asks, how does this impact your rubber band theory you spoke about? Yeah, I actually think it reiterates the rubber band theory, right? What it does is it says that the supply chains are so available, but the problem is the input costs, much to your argument, are still rising, right? Whether that's commodities or whatever, right? And that's probably because you're still seeing a feed through of higher labor costs, not necessarily because consumers are willing to pay more, right? This is a producer report. So this actually has nothing to do with the consumer's willingness to pay more. It also, in my opinion, probably still has little to do with the future supply chain expectations of when consumers go back to respending. I think what it mostly has to do with is you still have embers of inflation, whether that's much higher wage costs than we had a year ago, or commodity prices, which are still a lot higher than where they were certainly a year and a half ago. So I think you're still seeing that flow through. It is a little bit concerning that you're seeing, though, the month-over-month numbers coming in the way they are. I mean, look at, for example, the month-over-month numbers. Yeah, I mean, the month-over-month numbers were terrible. Final demand month-over-month 0.7, 0.5, 0.6. I mean, these are massive numbers. I mean, at an annualized rate, just looking at core food, energy, trade month-over-month, you're sitting at 0.6. That brings you out to an annualized rate of 7.2%. That's very, very high. Very, very high. So it's not great. Again, the rubber band theory applies to when consumers and this sort of consumer boom of potentially consumers coming back to respend, if markets start improving, are they going to be able to, or companies going to be able to support that demand? I think the answer to that is yes. I think the big issue is when you still have the embers of producer price inflation increasing, what you're really doing is you're relying on the cushion of companies to be able to absorb that. And so they end up taking it in the L, in the margin, right? I think that's where you end up getting smacked, is in margin, unfortunately. So this PPI report is very bad, I think, for producers of really anything that relies on high input costs. In the craziest way possible, companies that probably have the lowest producer price inflation are SaaS companies, right? And think about it, you're talking about tech labor, which isn't seeing the kind of increases in wage costs that you would see otherwise anymore. In fact, you're seeing more layoffs, right? This is, although, you know, that's sort of countered by a little bit of the fact that Fidelity is now apparently announcing they're going on a 4,000 person hiring spree. But that's a little bit different than the tech world. So the tech world, in a weird way, you have softer inflation in tech wages, layoffs in tech, and software doesn't as heavily obviously rely on commodities. I mean, to the extent that they're in servers and server racks and stuff like that. But beyond that, you could scale software substantially more than you could scale factories and goods that are exposed to sort of this producer price inflation that you're seeing. So in a weird way, SaaS companies get the best of both, less PPI and lower potentially tech overhead. Now, the valuations of SaaS are still a little rich, but boy, you're seeing some of them rebound substantially now because the earnings are coming in pretty dang good for some of these SaaS companies, which is not what was expected at all. So we'll see what ends up happening. But yeah, that's it's pretty wild when it comes to this PPI report. There's no doubt about that.